Hello, welcome back to this week's market update. Today is Monday, October 6th, 2025, and we'll jump right in. Markets continue to rally despite the government shutdown and the absence of the monthly jobs data, which hasn't been released due to the lapse in funding. Expectations remain for the unemployment to hold at 4.3%, with payroll growth of around 49,000 jobs. However, ADP's private employment data showed job losses in the month of September. Historically, there's not been a clear trend between market performance and shutdowns, though a prolonged one could weigh on GDP just given the size of government spending and employment in the US economy. For now, though, investors appear unfazed, with stocks rising over the past week. The Nasdaq Composite up 1.3%, both the Dow and the S&P 500 up about 1.1% over the past week. Moving into our economic data, in the absence of the BLS's monthly jobs report, which would normally have come out on last Friday, private sector data from ADP showed some insight into the labor market during the month of September. It showed that private employers actually shed 32,000 jobs in the month, driven largely by losses among small and mid-sized businesses here. As you can see, pretty heavy among small businesses, medium losses among mid-sized businesses, and actually job gains among large businesses with over 500 employees, but not enough to offset the losses in the other categories. By sector, the steepest job losses came from leisure and hospitality, professional and business services, financial activities, and trade, transportation, and utilities. So, with the BLS's data delayed due to the shutdown, markets are likely to focus more so on these private indicators in the meantime. In the same realm of that labor market data here, looking at last month's data on new entrant unemployment, kind of a center of attention in recent months as a lot of new college and high school graduates struggle to find career opportunities. You can see here the new entrant joblessness rate is actually at a 9-year high, the highest since 2016 here. So really important stuff to take note of as we analyze the market, analyze the economy, and see where kind of weaknesses and strengths are. So looking at the rate of unemployment among new entrants, in August, new entrants made up 10.8% of those unemployed, even higher in July at 13.4%. So a large portion of those who are unemployed, as well as the total number of unemployed, total percent of unemployed new entrants, has been on the rise, and so we want to keep an eye on this trend. We also got both the ISM Manufacturing and Services Indexes last week, with the Services Index coming in exactly neutral at 50. Anything above 50 is considered bullish, with anything below 50 considered bearish. So Manufacturing Index coming in at 49.1, that is slightly bearish there. This is the 7th consecutive month for the ISM Manufacturing Index being below 50 here. By category, you can see business activity was pretty neutral for services, slightly positive for manufacturing. New orders, slightly positive for services, slightly negative for manufacturing. Employment weak on both fronts there, confirmed in that ADP report that we just took a look at as well. And then last but not least, we see prices increasing and we see bearish readings in both the new export orders, imports for services, and manufacturing here in this chart. So a lot of trade disruptions caused by the tariffs, as well as just some restrained trade policy between countries, definitely causing some of the drag in imports and exports there. Looking at the longer term trend, I just want to point out that we have seen both gradually slowing over recent years. You can see the manufacturing index here in the purple. That has been negative to neutral for quite some while. That's not quite as much of a surprise there, but more importantly, the services side of the economy, which is a larger portion of the US economy, that has been on a gradual trend lower as well. So things we want to keep in mind as we assess the economy, markets, and all of these different data points together. These both have been on the decline really since the pop that they got post-pandemic when things were reopening. The unemployment rate was falling very sharply. Ever since then, we have been on kind of a slow decline. So we'll have to continue to monitor and see what the coming months bring in these data points. Last but not least, consumer confidence declined again in the month of September, falling 3.7% from August to its lowest level since this sharp drop in April. Households' assessments of business conditions were notably bearish, while perceptions of job availability also declined for the ninth consecutive month. So, again, some softness in the labor market, like we've been seeing across several different data points here this week. Inflation concerns also resurfaced as the dominant influence on sentiment. We had a lot of references to prices rising a lot in the month of September as the top factor shaping consumers' views of the economy. We did get some moderation in the mentions of tariffs, but they do still remain high compared to historical levels. So, overall, the September Consumer Confidence Index points to a continuation of a more cautious consumer outlook. That concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.